Let's get to the broader economy now. Joining us here on set, Komal Sri-Kumar, president at Sri-Kumar Global Strategies. Sri, great to see you.
Good to be here, Melissa.
So you actually think the first cut could happen in the April-May meeting, but it's not because inflation is going down. It's because of commercial real estate?
Exactly. I have been talking on the show, Melissa, about a credit event shock that is coming. I had put out 3-4 different factors. But now increasingly it seems to be coming from the financial sector, the banking sector. And even Janet Yellen, the Treasury Secretary, who until recently has repeatedly claimed that the banking system is sound, has given way to talking about her concern about commercial real estate. Yesterday, she told the Senate Banking Committee she is very worried about non-bank mortgage lenders. So you have, I think, what I call a CRE tsunami that is coming. The timing, you may disagree. You may say it's not 2 months, it's 4 months, but somewhere in the first half of the year. That's why I picked the May-June meetings for when the rates would be cut.
So you're not necessarily highlighting what's going on with New York Community Bank Corp, which was a surprise and generally perceived as idiosyncratic and specific to that particular bank. You're saying that there's something beyond that. It's not going to be in the public markets. It's these private lenders that are going to be the source of the problem.
Exactly. I do not think it is just idiosyncratic. And yesterday, Janet Yellen made a point of saying she did not think it was systemic. And I've been saying for the past year it is systemic. And it has been building up. And I think we are reaching a crescendo right now.
Is there a trigger that you see? Because we've seen or sort of forecasted that there would be issues with commercial real estate for quite some time, but there hasn't been that trigger. And I'm wondering, there was an article on Bloomberg this morning, or maybe it was last night, effectively saying that there could be ripples from China's need to sell some of these assets that they hold around the world.
Right. And again, yes, that is quite possible, but I wouldn't venture a guess, Melissa, as to where it's going to come from. But the China impact could be significant. We saw what happened in China with Evergrande and the liquidation. The property sector there is in deep dive. And to the extent there are sales which are going to elsewhere in the world, and the commercial real estate problem is also now in Europe, it is in Japan. So that's why I think it is systemic, and I don't know where the Treasury Secretary can say she doesn't think it is systemic.
Yeah, we saw a couple of banks in Europe having to mark down their portfolios.
Precisely.
And surprisingly, that didn't really have much of an impact here in the United States. It sort of happened, and then we all here moved on. I'm wondering then, if this is a tsunami, is this insulated within the economy, or does this have spillover effect across the economy?
It depends on how they handle it. And my guess is that if they do it earlier rather than later, which means cut rates faster and switch over from quantitative tightening to quantitative easing, in other words, don't act like you did in September 2008, allowing Lehman Brothers to go bankrupt. Supposing you had acted in July, August of 2008, and you had taken the essential steps, the drop would not have been as severe as it turned out to be. So perhaps they learned a lesson. They will cut the rates faster. They will switch over to providing liquidity faster. We already had one more experience with September 2019, where overnight rates shot up because of quantitative tightening. So they have a lot of experience. So I'm hopeful they'll act fast, Melissa, in which case you can limit the fallout on the rest of the economy.
So if the cutting path for you starts earlier than what some others are expecting, I'm wondering, Sri, if you think is the end point going to be the same? What is your forecast at the end of the year for where rates end up?
Once the rate cuts take place, and if it is taking place due to a credit event, two things happen. The cuts are substantial, and two, they happen very fast. And if that was happening, I would look for 6 to 8 cuts, or the equivalent of 50 basis point cut. If you call it 2 cuts as 50, 1 cut of 50 equals 2 of 25, some of that happening if the credit event, in fact, does take out to be very significant.
So if that happens and they do it swiftly, does that also shelter the economy from feeling what would have otherwise been a sharper tick up in, say, unemployment?
It would. In other words, we had a severe problem in 2008, and I think they keep repeatedly, both Jerome Powell and Yellen have said this is not 2008, this is a much smaller problem. They can make it a much smaller problem if they react faster, and in which case the increase in unemployment rate would not be as much. There is a cost. You're going to give up your fight against inflation, and that typically is what happens with the Fed. They keep fighting, and they find that they cannot at some stage continue with it, and inflation shoots up and they quit.
So by end of year, rates will be lower.
Lower.
And inflation will be higher.
Higher than where it is today.